المايك من عندي and I'll just also control this here. Assalamu alaikum, ladies and gentlemen. Hopefully you can hear us clearly. Can anyone just let us know whether you can hear and see us clearly, so at least we start the interaction with the market?
Yes, Fatik, we can hear you.
Okay, Bismillah. For the sake of bandwidth and connectivity, I will just switch off the camera and we'll run the slides. If there is any disruption, please raise hand, or if you have any question, you can put them in the chat. I have next to me the CEO and then the team, the board secretaries and the stakeholder relation team and the finance, if there is any discussion and highlights on those points once we run through the slides. With that, I will say Bismillah. Ladies and gentlemen, thanks for coming to interact with OCC's executive management and understand how we are moving and progressing in this Q1 of 2024 against the performance of past periods and the way forward in 2024. On overall, as regular, the disclaimers pops up. Please be cautious once you advise and take your kind of conclusive stance for investments. We are ready to answer any question whenever you would like to reach and clarify. The overall, the discussion would cover the same kind of path that we be quite leading to create sufficiencies in the market and support this industry in spite of the issues and the complications happens in this market being quite having no protections and the flow of the competition from wherever it is. On the second point, we'll highlight on the comparative financials performance of the company over last quarter and the 2023 quarter one. Then we'll have the session on the Q&As and the contact. Overall, this still stands as the paramount fact that for concrete values attached to OCCs once it comes that we maintain our brand quality. And as what we highlighted last quarter, we maintain our kind of licensing on the operation of those products once it comes to the international ISOs and standards of qualities. So we are still maintaining the APIs, and the companies really have moved right in 2023, even the performance of uplifting of the Q on the oil well cement in the Q4. Environmentally friendly, we are also taking the pacts on whatever projects that can help the country to be green. And we are already delivered this product to Al Borj, which is considered a low carbon dioxide emissions. And we are also moving on forward for projects implementations in 2024 with collaborative support with some of the government authorities. And there is a study ongoing. Once it's finalized, we'll pronounce it up. The stakeholder centricities, we are very driven for customer satisfaction, either internally or externally, and that's to continue as the far most important comfort that we need to create. Community is one stakeholder that we cannot miss, and we keep as our engagement and the CSR activities alongside. On overall, if you get to see the slide of the comparatives on the Q1, clinker, we have planned it a little bit lower because we have clinker on ground that started digesting and liquidating it in order to be quiet, having no much of trap cash and fruitfully generate the margins out of operation efficiencies created on the productions of the quarter per se or the period per month once it comes to month-on-month performance as well. On the cement production, you'll find the productions go in tandem to the market responsiveness once it comes to the sold quantities. And hopefully you can see my point, the screen pointer. I'm putting a laser pointer. So the green represent the actuals for the cement production, and the sold quantity is sluggishly less by almost we call it around 6 to 10,000, mainly because of the market uptick. However, in performance of the previous quarter, you will find us improved by almost 6,000 ton on the Q1 2023. And we are intending, inshallah, to continue to beat our performance as of last year, and we'll keep you appraised as we progress. However, according to the budgets, as we highlighted, clinker, you will find us more or less we are trying to lower whatever than whatever budgeted even, but maintain whatever have been quite utilized on the production. That's on the production. Utilization will be higher. Once it comes to the cement productions and sales, we try to match these two figures, but the responsiveness of the market will be coming to the point on the sales. However, also in the first quarter, there is this kind of some maintenance which has impacted a bit of availability, but has not impacted the sale pickup in comparative to the Q1 2023. And overall, the story can be focused on this specific quadrant of Q1. If you can see, on the revenue, we have already delivered around 18 million riyal. And if you compare it to the EBITDAs, roughly around 5 million riyal already been anchored into the Q1 itself. However, the net profit being in the circular of 3.4, and one may ask, with this specific positive performance, how would you see the year ending? Hopefully, we will try to deliver better than last year, but minimally to obtain and deliver the last year bottom line net profit of 10 million. However, last year was the impairment happens to be around 4 million plus, which has hit us. That yielded into delivering 6 million in net profit. So there is a positive trend that we will be coming to appraise you in the subsequent quarter in a positive performance to the 3.4. And well, also once it comes to the productions figures, as we've highlighted, that we are stretching the performance in overall. The 2022 still be quite unprecedented year of outstanding sold volume. Our ambitions is to beat the last year 3.3 and try to deliver higher than the 2022 by creating the efficiencies, which hopefully these efficiencies will come towards Q4 of this year. With that, we have already put this specific slide towards the end of last year and the quarter performance on the previous engagement. We've highlighted in the end of December, our latest estimate of the product mix would happen to be like this: 55 for OPCs, 31 on the SR, 31 on Al-Borj, and the other 3% in OWC, and the 11% on the SRCs. However, what have we delivered? There's only 1% which we have traded for from OPC, the ordinary Portland cement, and we increased the sold volume on the OWC, which is giving us highest significant margin. The other parameters, as we have projected, we have delivered that kind of specific sold volume. We intend to continue on this specific performance in the Qs to come to build the performance to deliver in 2024 around 50% in the OPCs and improving, and the OPC and Al-Borj. And there is another product that hopefully, if things moves, we would come in H2 to launch it, and then you will find it presented in our kind of product mix in H2 start. But we are doing this kind of finalization of this branding and publicities after we have already tested this specific product itself. With that, we wish to conclude, and if you have any question, we are all ears. The only thing I would like to highlight, you have seen the stock, how it has picked over the years, and unprecedented dividends has made this kind of spike positively in the responsiveness of the market. But if you compare as of last, this is as of today's, even before the market opened, 370 the trading price. However, if you compare to the last period once we presented, it was 355. So there is an appreciation of the stock in the market, and the responsiveness will be listening to you and driven to the performance of the company. And we are here to address any question that you might have. So over to you, audience, please. On the question and answers. Any question? No?
We have Nikita.
Nikita, you may come up, please.
Yes, hi, good morning. Thank you,
Yeah.
team, for the presentation and thanks for taking my question. I had a few. So first is that, could you speak a bit about the realization levels that you've observed in the quarter and what are your expectations going forward in the year? And maybe if you could answer that, then maybe I can start, ask my second question.
Yeah, just a minute. The realization on the NSR, the sales realization started to be positive, even on the despite of all those price competitions, and that is an overall. And overall, we have almost 0.3% on top of the 2023 end. And we still maintain our kind of differentiation price strategy on attracting market, but we have not got eroded once it comes to the NSR. So this is the positive fact that we will maintain to deliver the value.
Okay, and then so you mentioned that what you had budgeted for the output in terms of cement sales and cement production, it was over and above your budgeted level. So is this a trend that we should expect going forward as well? So because you are looking at the demand situation as well. The demand looks healthy. So what is your outlook there?
See, totally will be driven. First of all, we don't. The main thing that we will not trap cash in clinker. We produce to sell. So the main thing, we will just be quite sufficiently supplying to the market. And honestly, the team are on ground, despite there are so multiple areas of challenges once it comes to the market and the competition. But we are very poised now, and unlike a few years back, once it comes to the strength of the team on the commercial, once it comes to the sales and marketing. So we have people who are really on ground and managed to bring some new customers, and we are trying to build on that pact. So our kind of sales will be quite driving our productions of cement. So we don't have long stored inventories, either in the intermediary or in the finished products. And the market, you have I quote your statement, quote unquote, the market is moving dynamically positive. Yes, it is moving dynamically positive, but is not very steeply positive. If it is trending very steeply positive and the market open, even with these announced projects like His Majesty's, the cities, like the railways, like those kind of mega projects in Suhar and the areas in Duqm and other, if they come to be quite kickstart, and then we are all ready to support those specific initiatives under the nations. And most of those, I would call it awarded contractors like Dilfar and the others, they are our kind of customers who are loyal, and we are trying to keep that specific commitment to the other bodies in the play. And that's our strategy to move for the year.
Okay, thank you.
Anytime. Any other question of mine?
Any further question?
Any question from the audience?
Joyce.
Yeah, Joyce.
Good morning,
Please.
team. Thank you. Thank you for the presentation and congratulations on the good set of numbers. My first question is on your capacity utilization levels. Can you please mention what's your capacity utilization levels for the first quarter and how is it going on a YTD basis?
Just a minute. Utilization in the plant, we are into above the 95. So 95% utilization, we are moving on the plant itself. There's some shutdown which has happened for proper planned maintenance on the Crane 3, which is the major one. And luckily, it has been quite completed within the time frame. The overall, I would call it sweating of the asset or return on asset will be quite almost in the positive stance. And that's how we just intend to continue to maintain a reliable asset which deliver performance parameter on efficient, reliable product results. And that's what we would like to continue. Only we have one minor or two minor shutdowns for in August and November, but these are short periods for the small cranes, and these are already planned in our even production parameters. So we are expecting that commitment to be delivered positive than last year. And overall availability, reliabilities, and the utilization once it comes to delivering the results for the market. Joyce?
So this 95% is for first quarter or YTD 95%?
It's a kind of a first quarter, and if we take Y2Ds as of April and May, we'll have it improve to the 96, 97 range. And mainly if the market comes to be very responsive, this also might be available in a full utilization side.
So what's your target utilization levels for the remaining part of the year? Will you be looking at achieving 96, 97% for the remaining part, or
honestly,
will it be lower?
the average target is a 95. The average target is
Yeah.
95, and we need to maintain it. Unless there is something like what 2022 happens, we wish to exceed by all means. We want to beat the 3.3 last year, and that's whatever the market forces would need to drag it. The other the other force which can help us is mainly those additional market that we can bring, and we don't feel that we will need to stretch it higher than that. But however, market drives our kind of utilization as well.
Okay, thank you, Fatih. Another thing that is, you mentioned that there is a very high demand for cement right now, but we don't see that getting reflected in the realization levels. Your sales has been higher, but realization is not moving in tandem with the sales. So which means and it has remained stagnant over the last few quarters. So what are the reasons?
Not the case. Yes, come in, please. Sorry. Continue.
Yeah. So what are the reasons for this relatively stagnant realization levels? But ideally, we should see when there is high demand, we should see the prices going up. But we don't see that, especially when there is a scarcity of price availability, supply scarcity is still there. Raisut is not producing significant amount. So how do you see the realization levels? Is it a conscious decision by Oman Cement to maintain the realization levels, or is it something else that's playing there?
So first of all, Joyce, you are one of those analysts whom I wish they teach others. You are already matured in this kind of industry along with us, and you understand prior to 2023, the prices for Oman Cement even were lower. We have already adjusted by 2023, almost around 2 riyals in the bags and 1 riyal in the bulk, which has been maintained ever since. Prior to that, and in a coexistence of 2023 and subsequent, even in this 2024, you have this red ocean which we always speak about. The tug of the war between those kind of producers, manufacturers, and even the other grinding stations, it happens viciously. Other people are really losing margins and footing these margins to the customers, to the market, in order to just secure that base of continuity of sales. Oman Cement has not done this. Oman Cement has done only differentiation to attract new market, and that's the policy that we would like to maintain. Again, I attend, I think, Nikita's question whenever she asked about the NSR. Our NSR has not gone negative. Since 2015 to almost 2022, it was going down into the negative pulse. from 2023 even up to we moved into 2024 is still marginally positive if you build on that. Now you need to put this in a perspective that the government has already leveled down even the whatever the quality charge test for making it a little bit expensive to bring material inside the domestics. And it's not the case since 2023 around first quarter. So that's another what do you call it, antagonist or force, which is not really working right for Oman Cement securing market. But we have definitely moved different strategies, and we approach market different than other people. Once they offer discounts, only sales discounts for securing customers. And if you get to compare our prices even to the competitors coming from the neighborhood, you will find a big gap around between the 200 bases to 300 bases per bag, or if I say around 15 to 20% to 30% price discount, which means if we go into that philosophy, we'll end up losing margin and we will not end up delivering the results. Our due care is mainly to deliver bottom lines rightly improved than previous periods, and also ensure that cash flow generated would be quite sufficient, not just only for sufficiently covering the operation, working capital requirement, and growth projects, but also for enticing our investor communities and maintaining their expectation on whatever could be distributed. We maintain that specific pact to the market and to the analyst and to the investors. Hopefully, I addressed your point. If there is any further question, I'm all ears, gentlemen.
Yeah, thank you for that. So are you saying that we are at a premium level, on a pricing perspective? We charge a premium pricing as compared to the general market levels?
It's not a premium market. Honestly, if I go into the previous 2015, 2016, and 17 and prior, I would charge the market into the range of something like 25, 24, 23 riyals per metric ton, sold on a, let's say in the OPCs, whenever the market really was quite there and demanding and competition was balanced. People are not eating each other in this ocean. However, this is not the case here. Every now, the economy of scale, the no much of further aggressive movement on the infrastructure and developments in the neighborhood countries has resulted that they are over pushing their whatsoever production in order to stay afloat, or for just obtaining this specific cash flow for one reason or another, either covenants, either commitments, and you find how those people are cutting themselves there in the neighborhood countries, and you can read about how many of them they have just gone scaled down in their production or they have shut down for specific ABC reasons. Oman Cements will continue to maintain its strategy in positive performance, even on this NSR. If we're gonna go change our process, we will update and highlight this to you, so we can keep you also updated on the performance going forward. Over to you, Joyce, and the audience, please.
Thank you. And what's your outlook for realization levels, for the remaining part of this year?
Yeah, see now, I think I pronounced something which is yet to come in H2. We have one product, if that also comes to be a saver, our net realization will not go less than whatever we have maintained as of quarter one. And that would be only, we need to see how the effect of landing to the market as we started the Al Borj. If I go to Al Borj last, just let me go to that slide, please allow me. Where is this? Why it's not moving? Can you see over this slide? If you see, here, or the overall, Al Borj is in a light gray side. If you see that 2018 is nothing. We started in 2019 with 3%. And then this is the new product launch in 2019, and then gone into 4%. Then in 2021, 15%. And then we increased it to 25%. And subsequently in 2023 in 31%. Now we are intending to bring one new product, and if all the approvals been obtained and we are good to go, around both we will do it in H2, the new product roughly. H2 or around Q3, that is H2. So Q3, we come to the market. We will have something like 5 to 6 months testing the water of the responsive of the appetite of the customers, and that is new by standard and is differentiated product from other competitors. If we're gonna bring it, then that will help us into sustaining the trend positively, both on the revenues, the NSRs, and the other parameters on the PNL. Clear, Joyce?
Clear.
Any other question?
Yeah. Another question is on your capacity expansion plan. You had a plan to increase the capacity from 4,000 to 6,000 tons per day. And you mentioned in the company report also that it's ongoing. So when should we expect that capacity to come on stream, and what's the kind of investments that are required for that?
Yeah. See, the expansion is not a full greenfield projects or nor what you call it brownfield big volume expansion, but it's a kind of a debottlenecking and enhancements, mainly with the specific projects that we are now deliberating with the final stage with the board. And if it comes, it will start into the Q3 end, and that will really unleash the efficiencies and efficiencies of productions on the specific intermediary product, the clinker, and help us into optimizing the overall cost structure once it comes to the products. And once it comes to the investment, it will not be very sizable investments per se, but it's a small few millions here and there. The major projects is not purely on expansion of capacity per se, but rather than on the alternative fuel replacements, which is also according to our pact, as you see here, one parameter we say we need to be environment friendly. So one major project, which is multi-millions, we are trying to get it through with the authority. If it is cleared, then this will be the first of its kind in the country, and Oman Cement will play a role to promote it. We are aggressively working it with the authority. We have received none, I would call it binding by time, but binding by saying that good to consider Oman Cement for this initiatives, and we work it, and we have a time frame for Q3 to get this up and running as a concept. And once it's finalized, we will just pronounce it to the market in a full details.
Okay. So this Q3, when you said on the deep bottlenecking, the Q3 is this intended start date, or will it come on stream by Q3?
No, intending testing and commissioning end of Q3 for the capacity improvement for the intermediary product, for the efficiencies and the alternative fuel replacement or utilization. That project we intend to see it if things moves right. Q3 will be the announcement once things moves right. And then the Q4, we expect things will be quite in the design and studies. Hopefully, if we are in a better aggressive mode with all the strategic stakeholders to be quite positive catalyst on time. Well, hopefully around November, December, we may be able to come with the announcement of the project. Else in Q1 2025. But that is, we are working around the clock with also our strategic partner on this specific experienced AFR's concept.
Okay. And Fatih, if I may ask, if we start, let's say once we start the project, how much time do you expect it to get completed?
See now the enhancement on the intermediary, it's another 1 to 2 months self maximum, the clinical cooler. Yeah. Yes, 1 to 2 months maximum. The other one would take almost between 9 months to a year, right, boss? Yeah, around between 9 months to a year to be completed. Because this
Okay.
is a new concept even in the country itself.
And what's the kind of savings that we are looking at in terms of now the energy cost savings?
It can see in will give some kind of whatever happens in the other countries. If it is the same concept, it can go scaled up from the 10, 20, 30, 40, 50%, but it depends on the material composition of the items that need to be brought for this AFR project. I cannot disclose much more till we just get it finalized. And once it's ready, we'll just bring it across to you.
Got it. Got it. Thank you. Thank you, Frantik.
Thank you.
That's it
Anytime,
for me.
Joyce. Anytime. Any other question? Huh?
Vision.
Vision? ولا vision?
Vision.
Vision, please.
Hello.
Yes, please.
Good morning. Thank you for this call. This is Bishan Bhala from Vision Capital, and thank you for the answers so far. I just want to talk about your sort of. We spoke about the realization prices. If you could just touch upon sort of the cost of sales or cost of production per unit, how do you see that, and sort of where do you see that sort of stabilizing? And if you compare the same, give some commentary on that versus year on year, quarter on quarter. How do you see sort of that going forward as well?
So more or less, first of all, let me speak about the two major load on the cost drivers. One is this, and those are exogenic factors. One is this natural gas escalations, the 3% that ever started 2015. And the other one, which is the commitment of the country and the company to maintain proper urbanization level along with the 3% year-on-year adjustment for inflation that need to be factored for the manpower. These are two factors which are really heavily impacting our kind of cost. The other factor is about running operational costs once it comes to the plant-related operation. And on overall, if we normalize and we've taken the effect of those exogenic, we would have been significantly improved to the performance of the total cost per metric ton. So our kind of two driver that we are working on smartly is this kind of natural gas by bringing this alternative fuel. If it comes, it can substitute, as we said, from the range of 10 to somewhere around 50, but it depends on how we just test this specific partnership to come and the output out of those studies before we move. On the manpower, we also started with manpower rationalization and bringing those kind of fresh, nice calibers to replace the, I would call it yet to be retired or retired personnel who have been quite accruing long kind of good packages and starting those in the company itself, and also shifting people from one specific function to cover other functions wherever there is much of I would call it coverage of manpower by experience of those people in the cement industries. So we have worked on this plan on the cost per ton reduction, and we will continue that specific initiatives. One major thing we have started that's learned from the strategic partners, Holcim and Huashin, is mainly this cost benchmarking. Earlier, the cost benchmarking was not available for us to see it in the industry because in the industry doesn't disclose all these benchmarks effectively active. The beauty of joining Huashin, now we have access to all around more than 120 plants around the world. And on these, we see different parameters, among which we focus on those cost benchmarking. And now we started Q1 onwards, this initiatives to review and try to really tweak it right in order to see how we can improve. Yes, not each plant is the same mirror of others, but specific units are known for the comparables. So this is also something that we have not pronounced previously, but we are intending to maintain, and we can just give highlights as we go about how we are improving on our cost fitness, I would call it, cost structure fitness.
Thank
Any
you for
other
that answer.
question?
Now, yeah, thank you for that
Yeah.
answer. Now, if I look at, you spoke about sort of natural gas sort of replacement and savings between 10 to 50% over there. Now, you give us a split up of fuel as a percentage of overall COGS, which is around 35 to 38%. How much would natural gas be as a percentage of your overall COGS to sort of see what impact we can have over there? Because the salary part, I take your point in terms of having newer manpower, the 3% hike would still remain. That's something that's embedded in the system. So on natural gas, what percentage of COGS is natural gas specifically? Because you provide fuel, gas, and electricity. So if you can just split that to understand better.
Yeah, so the natural gas is predominantly the main element of this energy side and power, which is around 25%, one quarter of the total cost.
Got it. Okay, that makes sense. Fine, thank you. And if given that, because you disclose your numbers in terms of production, sales, and the overall cost of sales, your production cost stood around 16 reals last year, and this year in the first quarter it was 14 reals excluding depreciation and 16 reals with depreciation. Is that sort of a stable cost of production base, or sort of what efficiency you can see over there for, let's say, 2025, because all the initiatives are still in play for 24?
See, the overall, if you come quarter on quarter, we have already managed to deliver a reduction in the cost per ton around 1 to 1.8. And with this initiative further in this quarter to quarter, we will highlight how we are improving. And once this efficiency comes, also this cost will be quite tightened in order to see how the forward plan delivered. So there is this commitment from the company and the executive to really not to waste a single cent before thinking about spending a dollar. If we can maximize the extraction of value of that specific cent used.
Okay. And now, the operating performance we sort of understood from your side, you've sort of seen some cost rationalization, which would continue. On the sales side, realization prices are constant. If a new product is added, you might see some improvement over there on the realization, else it remains stable where it is. If I look at sort of your investment income source, now that we've seen at approximately 830,000 riyals. Going forward, that would significantly reduce or go to zero, right? Because of the payout, of the huge payout that you've done in terms of dividend. So what are your comments on the investment side?
So we are now, the strategy or philosophy is mainly to create a driving integrated construction material company rather than cement manufacturing companies. So we are trying to really put the Oman Cement into a different stand rather than only focusing partially on investment, being quite non-core profit generating elements, and concentrate on the core business per se to add value. Because one thing is mainly to create the sufficiency to the country in this industry, and then also add whatever lateral attachment and further downstream to this cement industry in a construction material. We are trying to bring it through the support with the strategic partner. So one part of the ecosystem that Khawashin does have and proven track record is this AFR, the alternative fuel replacement. And that's why our strategy for the year, since they have already acquired the government stake, it was this kind of specific alternative fuel replacement projects, and to bring it core for expanding the possibilities of growing the cement productions levels and also adding value by generating other or creating other products, as well also creating specific level of clinker being quite available as an intermediary product that could be sold, which we can highlight about it during the year if things moves right once the expansion or the additional enhanced capacity comes to be available. Further, further to this, the ecosystem in Huashin works in an overall bigger picture, but we can take that on the upstream of the aggregate, the ready mix, the equipments, which really complement the story if we want to grow the company to that target. This is the forward view on the coming 2 to 3 years to move year by year that we create enticing milestone and keeping ourselves distinguished, standing out of the crowd. So this is how the overall shareholders backed and however the executive management trying to deliver over the years to come.
Noted. Thank you for that answer. Now, you mentioned that, the debottlenecking and capacity enhancement wouldn't be a very large capex. But if there was sort of a project that would require higher capex, that obviously would be debt funded going forward, given that sort of company is debt free right now. Or would you generate enough internal accruals to sort of do further capex? Will you just give us some sort of insights over there? Because there would be a finance
Yeah,
cost angle to it as well, right?
no, definitely. See now, it's not good as even a CFO to keep the balance sheet very clean, not leveraged on our strength. So definitely will make the bankers having some targets achieved and delivered because they are our partners in the business and we are supporting and dependent on each other. The debt to equity structures of those specific projects will not be massively dependent on the market once it comes to the financing and the fund of source comes from the banking, because also our internally generated cash flow from operation is, I would call it, could be sufficiently covering the 50 to 60% per se if we want to go with loan consideration or debt loaded. So the structure of each project will be different from one to another on the debt to equities. However, our balance sheet is clean. Financing cost, even if it comes, we have different levers to look into the financing cost. There's means of suppliers credits that could be quite played rather than going on a full loan through the market. And then the other one is to pouch different currencies if we're gonna go into a more cheaper cost of funding if it comes to that specific requirement of supply of equipment, machineries, and plant for those specific projects. So the tactics, I think somebody is in the background serving some tea or what? I cannot hear the audience clearly. So that's one part we are working it. On the debt to equity, leave it to managements who have worked it rightly and fit with the steer of the shareholders. Believe it or not, we will be quite maximizing the position. We will not be accepting that we get eroded from the finance cost, inshallah.
All right. Thank you so much for that, and wish you all the best. Take care.
Thank you, gentlemen. Thank you. Any other question?
Yeah.
Sorry?
Samir.
Oh, Samir, long time, gentleman.
Hi, Mr. Fateh. How are you doing?
Alhamdulillah, by Almighty grace. So, what kept you
Uh,
away from us the last 2 quarters?
for some reason, I think I missed your invitation. Yeah, that's the reason why I couldn't be able to join. But thank you for the presentation and a
Please.
great set of numbers. Your one question is on, your chairman report was saying that is saying market demand for rest of the year is expected to be stable. Despite 2023 project awards was historically, I mean, not historically, if you look at the last 6 years, it's one of the highest. So why are you expecting a lower cement demand this year, despite such a huge project awards in 2023?
See, it's first of all, we are also subscriber to the macroeconomic infrastructure reports. And yes, some of them, they are poised to give this kind of highlight. Yes, project announced, But from the announcement to start going through this kind of all tendering, award concept, and then mobilization, it would take few months. So yes, it might, our statement on being stable, that we will maintain the performance and trying to improve positively. But if any of those projects kickstart on accelerated matters, then we are available. That's why also we stretch our leg to start those kind of debottlenecking enhancement to be quite available for the spring immediately into the supply support. So that statement could be modified on quarter to quarter whenever we see the pulse of those projects. Those projects are on our radar on daily basis. The commercial team give us update in daily reports on how the momentum and how the progress on each of those projects and how we are putting those pipelines confirmed, pipeline orders confirmed. So this update will come, Afnan and Iman and the team, once it comes to the next quarter, if there is a change in the market movement and the forces towards those mega projects.
Yeah, okay, that's very clear. And in terms of the cements from imports, is it still very significant, or are you seeing any kind of slowdown to that? Especially, we have seen a lot more project in the UAE. Does that help in any way?
See, we are a proponent of the FTA. We are one whole globe, but acting as one village. So let the best prevail. Let the strongest put their competencies to be quite comforting their kind of loyal and existing customers, as well also penetrate to attract new market. That's how OCC is poised to really work it. Market, maybe you might have missed this highlight. Since 2023, the government leveled down all the what do you call it, quality test charges and any kind of protection, which is fair and good. Let it be till the full sufficiencies comes from the domestic stance point of view, because earlier we had some trouble with other peer in the industry, and we wish our peer to come strong to complement our stories. So at least later on, the stand in the government comfort that we are really here. But OCC is working its own stand, despite our kind of peer comes or not. We are working strongly to create this sufficiency to the market. This is a commitment that we would like to continue uphold and work to deliver it.
Got you. Maybe one last question from my side on you mentioned the specialized cement like Burj. So could you let us know what's the price difference between this Al Burj and the ordinary Portland cement?
I'll reflect on the Al Burj for the new product. I will disclose whenever we have fully the full approval. On Al Burj is roughly the differential is around 1 riyal on the what do you call it, cost, and it also not just on the cost per se. It's a green cement. It's a
Okay.
better than the OPC once it comes to the CO2 emissions. And unfortunately, honestly, there's some demand from the European market, but the quantity is not that I would call it massively available with us. Once we have that growth on the enhanced capacities, we might be able also to offer some specific support to other countries. But our concern now is mainly to create the sufficiency in the local domestic market. Clear? Any other question?
That's very clear, Mr. Fatih, and all the best for the
Thank you,
coming
Silver.
quarters.
Thank you. Thank you, Silver. So if there's any question, we are still available. If not, then you may conclude, please. With that, I say thanks to all interested audience, to the market, to the gurus who are helping this industry to grow, to the players on putting right concrete advice to the investors community. We are available for the reach anytime you would like to clarify, to discuss. Some of you intermittently reach out to us, so you please feel free to call and contact us if you have any query. These are our contacts. I still to be quite the fourth tier of communication, but all of these channels are available for you. Only we have our colleague Iman is coming to support on the stakeholder relation. With that, thank you, gentlemen. Thank you, young ladies. I'm looking forward to interact with you subsequently. Thank you. خلاص check out.